Hello investors, welcome to the channel. For today's video, I'm going to be showing you a couple ways to buy to close. Now, if you guys have been doing covered calls in your options portfolio, then this is a video you definitely must watch. We're going to get a big detail and intricate with options today. Now, also, if you're new to options trading, then you should pay close attention to this video. It's going to be a bit more advanced, but this will definitely help you learn a bit extra and propel your covered call options career. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. For today's video, I'm going to be going through a couple ways of how to buy to close out of an options contract. We're going to be using a live trade in my portfolio that I currently have, and I'm going to be demonstrating how to buy to close on Robinhood and also on other brokerage platforms. So, without further ado, let's go ahead and we're going to be getting very down and dirty with options in today's video. So as you can see to the top, this is an option contract I have open. It is a sell call. The reason you know it's a sell call is because you could see it right here to the top. Now I'm going to break this down in detail for you before we proceed a bit further. So currently this is Sound AI and the current price is at $15.23. I do have a covered call I'm using and my strike price I chose is at $17. For those of you that don't know what a cover call option strategy is, I'm going to explain it to you real briefly. So, with this contract, what I'm saying is that at expiration date, if Sound, which is now trading at $15.22, if it goes past the $17 strike price, then I'm willing to give up my 100 shares. And in order for you to do a covered call option strategy, you must own 100 shares or multiples of 100 shares. Now let's go ahead and we're going to go down and I'm going to explain the trade to you. Okay, so here we are on the exact trade and I'm going to break down this part right here to you. I'm not sure if you guys have ever familiarized yourself with this part, but this gives you all the information about a covered call. So to start off, we're going to see right here, this tells you that the current market price is 0.47. So if you were to jump into your portfolio right now at this moment and you were to sell a covered call at this price and at this expiration date, you'd be receiving a credit of 47 cents. However, when I did it, I received a credit of $68. As you can see here, 0.68. The expiration on my covered call, as you can see here, is 2/21. Now, on the second line to the left, you're going to see the current price of Sound is 15.21. And once you go below that, you're going to see the return. The return is $21. The amount of contracts I have is 1, as you can see, as demonstrated by -1. And the date sold was February 10th. Now, just by seeing this part of the covered call only, if I decided to get out of this covered call right now, I would be making a profit of $22 right off the bat. That's the information this here tells you. Now, my personal preference, I like to close my covered calls or buy to close my covered calls whenever this percentage here gets to 75% or higher. That's just based on my own risk tolerance. So this at 32%, so I will leave it alone. However, I'm gonna be getting down and dirty and show you how to buy to close this out. Now, something of extreme relevance as well, I would like to show you the implied volatility. When trading any options, you're gonna need to choose stocks that have a decent implied volatility. Now, as you can see here, the implied volatility is about 100%. Let me break it down to you. Implied volatility of anywhere between 0% to 50% is very low. You will not be receiving some decent premiums. Implied volatility between 50% to 100%, as you can see here, the premium are going to be really, really excellent without being too risky. Any implied volatility above the 100% mark, the higher you go above 100%, that is going into very risky territory. Now, let me show you why. The current price of Sound is $15.22 or thereabout, and the premium I received was 0.68 or $68. If you were to divide the $68 by $1,500, which is going to be the total price to acquire 100 shares, you're going to see the rate of return on this is going to be 4%. 4% is very high, but it is not high for this type of stock. So you also need to know the difference in the type of stock that you're trading. Now we're going to go down a bit further and I'm going to explain to you the volume right now. So down here, you can see the open interest and the volume. The open interest down here tells you that there's 4,293 people with this contract. Now, right to the top of the open interest, you're going to see the volume. The volume tells you that 2,438 contracts has been gone through today, means open and close today as of making this video. Now let's go ahead and buy to close. So with Robinhood, Robinhood makes things extremely easy. That's why Robinhood is an extremely user-friendly platform. If you guys do not have a Robinhood account, then feel free to check out the link in the description below. Now, if you were to buy to close this option with Robinhood, you simply have to do review order. So what Robinhood does is that it pulls it up right away. It's automatic. To be a responsible trader, you need to fill in the blanks. So the amount of contracts I'm going to be buying to close is going to be 1 right here. And below that, you're going to need to choose your price at which you want to pay to buy back your contract. Now, right here, you're going to see if I leave the 0.47, which Robinhood suggests, my likelihood of being filled is going to be very high, meaning as soon as I execute this contract, it's going to go through right away. Now, if I were to go into it and choose my limit price, let's go with 0.45. Then you see down here has changed to low likelihood of being filled. This does not mean you're not going to get filled. All it's telling you is that your chance of getting filled is very low and it's going to take you a lot longer time. Do you have time to wait for your trade to close for just a difference of 2 pennies? These are the decisions you have to make every single day. Now, below that, we're going to have our time in force. Let's say you're a regular 9 to 5 worker and you don't have time to sit behind your computer. Well, you simply go into here and you can choose an option. The first option is going to be good for day. That simply means is that if you were to do this option and you choose good for today, you could leave your computer and go and do whatever you have to get done. Whenever that price hits, then this option contract is going to be executed. There's nothing else that needs to be done on your end. Now, so the other way you're going to get out of this contract, come end of options trading day, this contract is automatically going to be closed out if it has been executed. And then the next day, you're probably going to have to try to get it closed again. Now, with the good till cancel, this one is a bit different. And this one is if you hardcore want this exact price. So the good till cancel is going to last longer than the day. So this is going to stay here for 3 days, 2 days until expiration date. Unless this price that you chose is not hit, this contract is not going to be cancelled. And you go ahead and you simply hit review. Now I'm going to go ahead and show you how to buy to close if you're using any of the other brokers out there. So let's go to view all options. This way uses a few extra steps. So with this way, you need to be more familiar with options trading. So the first order of business, we need to find our original sell call order because a covered call is a sell call. So we're going to go to sell call. We're going to choose the date we chose for our expiration, which was February 21st, and we need to find our contract. And as you can see, it popped up right here. So now that we found our contract, now we're going to go ahead and we're going to buy to close it. So we're going to go ahead and we're going to go to buy to close. We're going to go ahead, click our 17 strike price, and then it's going to pop up right here. We're going to go ahead, hit continue. And just as I showed you before, you choose the amount of contracts you want to close. If you have 5 contracts open and you don't want to close all 5 at the same time, feel free to choose how many you want to close right now. So I'm going to go with 1. And this time I'm going to leave the suggested price right here. I'm going to leave the good for today only. And down here it's showing you your max cost. Your max cost is that it's telling you that if you want to buy to close this, you're going to have to pay $48. Now remember, I showed you that I received $68. If I were to buy to close at $48, that means I'll make a profit of $20. Now we're going to go down to review order. And there you have it. In order for you to do the covered call option strategy, you must leave a collateral. Your collateral is going to be 100 shares or multiple of 100 shares. So as you can see down here, it says you're paying $48 in order to buy back one open contract which will release your collateral. So whenever this option is executed, then this 100 shares is back into your portfolio. And then you could go ahead and do this strategy over and over again until you get assigned. Assignment means that if expiration date comes and sound is trading at your strike price anywhere above it, then you're going to be assigned, meaning you're going to have to now sell these 100 shares right here to whatever strike price that you chose initially. Now, this is one easy way in order for you to buy to close. And now I'm going to show you a different way. So remember, when you do get back your 100 shares, you're going to be doing this strategy again for the next period and the next period. So the other way you could close out this option strategy is what's going to be known as rolling. So this is how you go ahead and get that done. We're going to select our current contract, and now we're going to go ahead and we're going to sell another covered call. We're going to be going out one expiration date, which is February 28th. And remember, feel free to choose any expiration date of your choosing. This is just for the purposes of this video. And we're going to be choosing our exact same strike price. Once again, this is just as an example. So we're going to use the exact $17 strike price. And now we're going to be receiving some additional premium. So the additional premium we're going to be receiving is going to be $57. So this is another way in order for you to buy to close. So in addition to the $68 that I received initially, which I showed you, if I were to use this way to get out of the contract, then I'll be getting an additional $57. And that's another way how you buy to close. Buying to close a covered call options contract serves one purpose. It serves the purpose of you locking in your gains. There is no need for you to wait until expiration date for the contract to close by itself. You have the power to close it out whenever you feel is best suits you. For my personal preference, whenever I'm doing covered calls, I always like to buy to close whenever it gets to 75% or higher of profitability. That's good for me because I like nothing better than to lock in profits. Now, if you guys got any value from this video, go ahead, like the video, subscribe to the channel, and most importantly, share this video with anyone you think will benefit from its content. And until the next video, keep pushing your investments.